Good afternoon, ladies and gentlemen. Welcome to the RadioActive Trading presentation for Thursday, June 21st, 2012. I should say good morning to those of you that are joining us from the Central Time Zones, the Mountain Time Zones, or Pacific Time Zones. And as always, I also want to say good evening to those of you who are joining us maybe from across the pond, out in parts in UK, or maybe out in Europe. And of course, good early morning to those of you who may be joining us from Asia or Australia as well. Well, from the promotional email that you received, what we're going to do today is I'm going to share with you my experience and how I got started with options trading, and experience maybe some of the same things that you are possibly experiencing right now with your trading, with following the common strategies of investing. We're going to take a look at the Trade Simulator tool here under the Resources tab at RadioActiveTrading.com to sort of compare the different risk-reward profiles of those positions. And I'm going to try to emphasize the importance of how hard it is to consistently make profits with some of those strategies in the way that the market moves. Then we're going to go through the 3 core principles of radioactive trading, which we also covered on Tuesday. And after that, we're going to talk about the SLW trade. Many of you have seen this before, the first step, bulletproofing it with income method number 1, one of the 10 income methods that's used in radioactive trading. But we're going to look at it with an eye to the CEGA model, which is what we use and what's discussed in the blueprint and what we use to help us identify which income method might be best for the position. And then we're going to link over to power options. We're going to take a look at the webinar portfolio for married puts on power options and see if there's the potential to make any adjustments on those positions today, again, keeping an eye on the CEGA model as well. Well, just want to introduce myself first, because this is where we're going to start here. We're going to start with a little brief history of how I started trading and see if that also is similar or if it rings a bell to what you're doing right now. My name is Mike Chupka. I'm the Director of Education here at Power Options. For those of you that don't know, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. We do support over 23 different strategies in Power Options. Now, I handle a lot of the coaching sessions, webinars, obviously, and some of the education on the site. I am versed in all strategies that we support, plus others that aren't available on the site right now, some of the more complex strategies that aren't commonly used. And I've co-authored 2 books on options investing, one on naked puts, one on protective option strategies using different forms of married puts and collars in the markets, which is sort of an introduction, a very base introduction to the blueprint. I am, like many of you, a retail investor. All right, I'm trading with my own money. I don't have a seat on the exchange. I'm not a member of CBOE, for example, and I'm not a market maker. I learned options under Ernie Zarenners, the president and founder of Power Options, under his tutelage. That's how I learned options. And I started off with a small account, and thankfully I have been able to grow that account over the last 9 years. But when I got started, that wasn't necessarily the case. When I got started with a small amount of capital, when I first started working at Power Options about 9 years ago, and of course when I went to apply to trade options at my broker, all I was really allowed to do was covered calls and maybe buy calls and buy puts, and I had to apply later to trade naked puts. But I learned the covered call strategy and naked puts from Ernie. He'd been trading for about 20 years before he founded Power Options. Now, covered calls, as we all know, is probably the most common options trading strategy. Even if you're trading maybe spread positions or vertical spreads, and that makes up most of your portfolio, you may have 3 or 4 stocks in your portfolio that you've had for years that you're maybe trading out of the money calls on to just generate a dividend-like income. And over time, you're just trying to reduce the cost basis on those positions. So even though you consider yourself a spread trader, you may have a few covered calls in there as well. Now, covered calls are level 1 trading. When you first apply, if you haven't traded options before, if you're just getting started, when you apply, they'll allow you to do covered calls, and it's promoted as a safer investment approach. And there's all sorts of weekend seminars you can take, $3,000, $2,000 to learn how to trade covered calls. And maybe it's a couple spread trades, for example. In 2 days, you're going to become a master at covered calls trading. Well, not really. That's what happened to Kurt Frankenberg, of course. Many of you are familiar with Kurt, the president and founder, or I should say the founder of RadioActive Trading, where he spent $3,000 or so to learn how to trade covered calls over a 2-day seminar. And he did very well for the first couple of months. In the 3rd month, his guru told him, hey, you're going to be able to do a lot better if you start trading on margin. So Kurt followed his guru's advice shortly afterwards, he had lost all the money he had set aside for trading. Now, hopefully many of you don't have that same experience, but I'm pretty sure that many of you have the experience where you were touted a safe strategy to make money in the market to generate 3 to 6% per month on a consistent basis, and slowly and surely over time you perhaps watched your account capital dwindle and shrink rather than grow. And that's the same thing I experienced as well. I was also introduced to other strategies from the power options customers, customers that were trading vertical spreads and more complex spreads such as the calendar spreads, horizontal or diagonal. And I picked up those techniques from Ernie and as well as from the other customers at Power Options. Well, many of you are familiar with this risk-reward profile and the covered call strategy. It's probably the most popular option strategy, and the idea sounds very attractive. If we're thinking about owning stock in the market anyway, hey, why don't we buy stock? Why don't we sell calls? We're going to rent our stock out, generate a monthly premium, sort of like leasing a property, and we just collect the money month by month by month. Well, there's a problem with the risk-reward profile when we break this down. It does have the same risk-reward profile as a naked put. They're essentially parity trades of one another. A covered call or naked put position caps the potential upside gain, but still takes on most of the risk of owning stock. Now, if I buy a stock and I sell a call and generate 3% of premium, if the stock moves against me quickly, if it declines quickly in price, well, if we look at just the risk-reward profile, the worst-case scenario, I'm still risking 97% of the capital I invested to buy the stock. But as I mentioned, this is highly touted as a safer strategy. Okay, and I don't really agree with this being a safer strategy. Now, a lot of investors will tell me that, and just as I know as well from the first 18 months I started trading about 9 years ago, well, it's okay if the stock falls. You can roll the call down and you're still generating premium. A lot of times we see stocks fall very quickly. In a 3 or 5 day period, we may have a gap down of 10%, and then the stock continues to fall down in price, maybe another 5%, maybe another 6%. And the idea is, oh, well, you can just roll the call. Well, think about it this way. If we bought a stock, and in the first month we sold the call for a 3% premium, the stock gaps down 20% or so. This is more common than you think. It does happen in the market. And if you have set an 8% stop loss, but there's a pre-market or after-market gap, you're not going to get filled at that 8%. The stop loss is going to get violated, and you're going to get filled at that 20% loss. But for you, the covered call seller, that really equates to only a 17% loss or so because you did keep that 3% premium. And you say, well, I can just keep rolling the call down and sell a lower strike. Okay, well, we've got a 17% loss in the position. We're able to average maybe 2.5–3% per month. So right there, assuming the stock stays the same or even if it moves back up, if you're generating a 3% or so premium on that position, that's going to take 6 months to get back to break even. And you're going to have to hope that the stock comes back up. But now there's a caveat. The stock drops 20%. The only way you're going to get that 3% premium is to sell a much lower call. Now if the stock does get back up in price, you can run the risk of getting assigned for a loss, in other words, locked into a loss. Now, a popular saying in the market to be successful is we want to cut our losers short and we want to let our winners run. The covered call and the naked put strategy don't really appeal to that axiom for being successful in the market, do they? We're actually cutting our winners short and allowing our losers to run. And over the past 9 years or so, one of the most common discussions I've had with customers who are trading covered calls is over time, if they've been trading for 6, 7, 8 months, they start to notice is that covered calls are a sorting machine. The winners, the stocks that you picked right that may move up 8, 9%, excuse me, over a 30-day period, well, you get capped out at a 3% gain. Well, you made your goal. You made your 3% goal, but you're not taking advantage of that upper gain. So the winners are getting called away from you, but those losers, the ones that declined in price, are staying into your account. Chris had mentioned it's, because Wall Street believes for you owning stock is safe, not how low it can go. That's kind of true, and that's why they're being highly touted. That's why covered calls, of course, are being highly touted by brokers and by the market as a safer strategy. So that's something I agree with. All right, so we all do have the same goals in the market, don't we? We want to make profits consistently, and we want to limit our losses or reduce our risk to make sure we keep those profits. We're going to want to cut our losers short and let our winners run. And of course, the basic rules that we all need to apply, no matter whatever strategy we're using, is we never want to overtrade or overinvest. There's no such thing as a sure thing, and I was guilty of this when I first started trading. I thought, I know this stock pretty well. everything looks great. There's no way this could go against me. Now, that's where we get into trouble. That's when we start to suffer those 30%, 40%, 50% losses, and we need a much bigger gain to get back to break even. As options investors, we want to manipulate time value in our favor, and we get into the 3 core principles. We're going to take a look at how, as radioactive traders, we use the time value not only in the initial setup of our protected position, but also in the 10 different income methods as well. Now let's just go into a brief history, and I'm going to keep this brief here. I'm sorry for a lot of words there here on this slide, but we're going to keep this brief, but I just want to relate to you how my experience might be equal to yours, okay? When I first started trading with the covered call strategy, the first 18 months I started trading, I encountered the same problems you might be familiar with. I never had a problem with the wins. Set out with that goal that I mentioned of making 2.5%, 3% per month, the great idea of getting assigned on those positions, not being married to the stock, taking that extra 3% capital and just rolling it into the next month, getting into a new position, hope to find another 3%. That all sounds really great, but what I experienced is that I would have 3 or 4 months of successful trading where I'd average, my 2.5%, 3% that I wanted, but then the 4th or 5th month I'd have about a 50-50 success on my, 8 or 10 covered call positions. Now, unfortunately, let's say I had 8 positions open, 4 of those go up and get assigned at 3%, and then the other 4 had dropped 10, 12, or maybe 15%. And looking back at that, now that I have 4 positions that have dropped on average about 10 or 12% on me, even with the 3% premium I collected, after that 4 months, after clearing out my positions in the 4 months there, at the end, I'm actually right back where I started from 4 months ago. And then I'd have the same cycle. I'd have 2 or 3 months of successful trades, and then I'd have a month with about a 50-50 success rate with the covered calls, and now I'm 7 or 8 months into trading, and I'm still only a little bit ahead or a little bit below of where I started 8 months ago. So I'm not seeing what the gurus are clamoring about. I'm not getting those results of 3 to 6% consistent profits trading covered calls. Well, one of the biggest problems we have, of course, is we don't know the future. If we knew the future, it would already be priced in. Don't get me wrong, it'd be great if I knew the future on a stock. We'll talk about that a little bit later on the silver wheaten position when we get into it, and perhaps even the live trade we're going to take a look at today for adjustments. My opinion over time is that stop orders are assumed insurance. I followed the rules, the IBD rules, Bill O'Neill, for example, setting a 7 or 8% stop loss on my covered call positions, but you're going to cross that earnings, or you're going to have an early earnings warning announcement. The stock's going to drop 20 or 30%. Chris just mentioned that one of the trades that Kurt's in right now in the Fusion portfolio, Bed Bath & Beyond, BBBY, just had a significant gap down today on earnings. Well, Kurt's protected on that position, so that's good, and he actually has an income method on it that may work in his favor now that the stock has fallen a little bit. He can manage that as well. So if I was in Bed Bath & Beyond and I was trading a covered call and I had a 7 or 8% stop loss and this morning's news came out and the stock gapped down, again, I'm not going to get filled at that 7 or 8% stop loss. I'm going to get filled at the lower price. The stop loss is really a market order that once that's triggered, they're going to close you out whatever price they can get. So even though I had my 7 or 8% stop order in place, I'm going to get filled for a 20%, 25% loss. And one of the other things that is very common, and I know a lot of you here, I've seen a lot of you online before, and you're familiar with this, but it actually didn't register with me when I first started trading. I didn't look into it as well as I should have in those first 10 months or those first 8 months, is that if you suffer a 10% loss on a position, you don't need a 10% gain to get back to break even. You need about an 11% gain. And a 10% gain on one position isn't going to counter a 10% loss on the other. And it could make 10% on a covered call anyway, but you get the idea. It's a slippery slope. If I suffer a 20 or 25% loss, as I may have suffered with Bed Bath & Beyond today with a stop order in place, I'm going to need a 33% gain to get back to break even. And if I suffer a 33% loss, we've seen those positions with Kurt's Fusion trades on Digital River, for example, recently, and a couple of others. But if I got stopped out at that 35% loss, 33% loss, I'm going to need a 50% gain to get back to break even. It's a really slippery slope. Now, when I was first started handling the phone calls here at Power Options, we were supporting a lot of services that did teach covered calls. And a lot of the customers from those weekend seminars would sign up for Power Options, and they still do, of course. But I had the same question pop up over and over again. And I would get that question, how can I better protect a covered call trade or a naked put trade? The stock just gapped down. How could I have stopped this? What investors were really asking me is that, hey, other than putting more money into the trade to buy a put option, is there a spread or some secret I haven't heard from where I can trade a spread position, generate premium, and that would limit the covered call risk? Well, not really. There isn't a magical trade out there that does that. When you want to protect that covered call or that naked put, you're going to have to spend some money there to insure the position. And a lot of people would say, well, I don't want to put more money into this trade. I don't want to put more money into this covered call because then I'm losing out on my gains. Well, do you want to try to maximize your gains at that 2.5%, 3%, or do you want to protect the 97 or 98% that you have invested in the stock, which is really your true investment? In other words, is it better to try to maximize your capital, or is it better to protect your capital so you still have capital left in the worst case scenario? Now, how did I try to solve the problem? After that first 15 or 18 months of covered calls, actually before then, probably my first 8 months of trading, when I realized I wasn't getting ahead with covered calls, I started playing with standard collars, and I still trade those with about 20 to 30% of my personal account. It's a similar approach to covered calls. I'm going to buy stock, I'm going to sell a near-term at the money or slightly out of the money call, and I'm going to buy a near-term out of the money put. So same expiration month, out of the money put, at or out of the money call. And I still have the potential to make 2 to 3% on those positions, but I have a lower probability. The stock actually needs to move up, so I'm probably looking at a 45 or 40% probability of getting assigned and earning that 2 or 3%, but I am risking no more than 5 or 6% on the trade. Now right there, you see something interesting. Now this is a little bit better than a covered calls portfolio, because if there is a 15 or 16 or 20% drop, I'm guaranteed not to lose more than 5 or 6%. But if I'm only making 3% when I'm right and still risking 5 to 6% if I'm wrong in the worst case scenario, I'm still going to have to be right more often than wrong in order to make money. In fact, I'm going to need to be right about 66 or 67% of the time in order to consistently profit. I also played around with calendar spreads. That's another attractive jump from covered calls trading. The idea is, well, instead of putting up so much money to invest in the stock, why don't I buy an in-the-money leveraged call option instead of the stock and still sell the same at the money or out of the money near-term calls against it? Leverage my invested capital, less monetary value at risk, higher potential percentage returns. Well, briefly, the calendar spreads, I was mainly doing diagonal spreads. Diagonal spreads for a 4 or 5 month period were the most profit I've ever made on any option strategy. 2 or 3 months later, calendar spreads were the strategy that led me to suffer the biggest losses I've ever suffered in an option strategy. So that leverage works for you and it works against you. I was never good at buying calls and puts for speculation or doing straddles and strangles. I never profited with that over time. And vertical spreads and iron condors, the bear call credits, bull put credits, following the rules Mike Phillips from Power Options Applied did with the iron condors and the broad-based indexes and ETFs, for example. And what I found is that with my job description, with what I do during the day, the webinars, the coaching sessions, those have the potential to be profitable, but you have to watch them a lot more closely. And I suffered a few losses because I wasn't able to track the positions closely. CW, give me 1 second. CW asked, what is a diagonal spread? I'm going to show that in just 1 minute. In my mind, there's 2 forms of what are called calendar spreads. A horizontal spread where you have the same strike for the call that you're selling and the call that you're buying, but the call that you're buying is further out in time. That's a horizontal. A diagonal spread is where there are different strikes, where I'm buying an in-the-money call that's far out in time, 6 to 8 months out in time, and I'm selling the 1 month out at the money or slightly out of the money position. That's a diagonal calendar spread. Okay, we'll take a look at the minute. Standard collar, of course, we see here that it's similar to the covered call where we have a capped gain and we have a capped loss on the position. It is safer. I will agree with that. I've limited my risk to only that 5 or 6%, but it still caps the upside. I'm not allowing my winners to grow, but I am helping to limit my losses on those positions. And as I mentioned, I still have to be right more often than wrong in order to profit. And CW, here's the calendar spread. We're going to buy a far out in time in the money call, sell a near term at or out of the money call. So instead of buying stock and selling it at the money call, I'm using leverage to buy an in the money call, but that call I'm buying is farther out in time. We're buying call in lieu of stock. It does have limited gains, and the risk is limited to the total net debit, but the real risk is in over-investing. And we'll talk about that a little bit when we get into the 3 core principles. Because, you just think about if I had $5,000 to put into a trade, if I'm looking at a $20 stock, well, that dictates that in a standard collar position or a married put position, I can only buy about 200 shares and buy 2 puts, for example. If I'm looking at an in-the-money long call, that $20 stock, let's say a 15 call that's 6 months out of time, it might cost me $9 or $8 or so, and that means I can buy a lot more contracts, but I'm putting a lot more of my invested capital at risk on that position if I'm not careful. Okay? And this also leads us into the lie of leverage. Leverage can be used against you just as it can be used for you. That percentage return, a diagonal spread, since I'm essentially selling the same call I would in a covered call, but I have much less capital into the position because I'm buying that in the money call, well, this can work against us. Let's think about this. If we're in any trade, any strategy, if we lose 5% on our position, and then we make 20% on our next trade, and then we lose 5% in 3 trades, where is that going to leave us? Well, we can't simply add the values. It's not going to be 5%, 5%, so we lost 10% and we made 20%. We're not going to be 10% ahead. Now think about this, though. Which looks more appealing to you? And you can use the question pod to send that in, but which looks more appealing to you? If you had a trade, a strategy, in the first month you lost 5%, second month you made 20%, and then you lost 5%, or your first month using leverage you lost 40%, then on your second trade you make 160%, and then you lose 40% in the last trade. Which would you rather have? And which looks better to you if you had 3 trades in a row? Would you lose 5%, make 20%, then lose 5%, or lose 40%, make 160%, and then lose 40% in 3 trades? Well, let's look at the first response. 5% loss followed by a 20% gain, and then another 5% loss doesn't come out to a 10% gain. It comes out to about 8.3. So if we invested $100, we lost 5%, our account's now going to be at $95. We make 20% of that $95, we're going to be at $114. Then we lose 5% of the $114 we had, now we're at $108.30. So it's an 8.3% gain. Well, we have to do better when we use leverage, right? Well, let's take a look at that. If we had that $100 and we lose 40%, we're going to be down to $60. We take that $60 invested in our strategy, and now we gain 160%. So we're going to be up at $156 now in our account. We invest that again and lose another 40%. We're now down to $93.60. This equates to a 6.4% loss. So even though we had this giant gain, and it looks like we should be ahead by 80% if you just add the numbers, that's not how it works in the market. That's not how it works in trading. The lie of leverage can work against you and really hurt your portfolio. Now, solving the problem, when we think about it, stock or options trading is an investment. Just like if you're buying a car, you're buying a new house, if you invest in fine art or any type of valuables, you're going to insure those positions. They're investment over time. Even options trading itself, if you look at it and say, oh, well, I'm a day trader or I trade weekly spreads, you're still essentially investing in the stock. You have an invested sentiment in which way you want the stock to go. The common approach to insure stocks is the married put. And as you all know, if you read any free information at your broker, for example, the married put is commonly defined as buying stock and buying a near-term out-of-the-money put option for low cost, much like the portion I would do in a standard collar. That problem is it limits risk for only a short period, and it may not limit risk enough. If I'm buying an out-of-the-money put, of course, I still might be risking 10, 12% because the insurance policy doesn't kick in until the stock hits that lower strike price. Now, as we can see here, when we're looking at a married put or what's called a protective put position, we're forced into a trade which satisfies that popular trader's axiom for success. We are cutting our losers short and we're allowing our winners to run. The losses are limited, the gains are unlimited. The common way of teaching it of buying an out-of-the-money put option near term does not put the time value in our favor. It's going to increase our annualized cost if we're buying a put month by month by month. Now, we advocate a better approach to the married put position. What we're going to do in radioactive trading when we open any new position is we're going to buy stock, we are going to buy a put option, but we're going to buy an in-the-money put option that's far out in time to maximize our insurance minimize our cost for insurance per day over that 5 or 6 month time period and make sure we're set in a position where we can only lose 5 or 6%. Now we're going to show more of that setup when we get into the 3 core principles of radioactive trading in just a minute, but before we do that, I want to link over to the trade simulator tools we talked before, and let's put some of this into action, okay? We're going to go into the resources tab here at radioactivetrading.com, and here you can sign up for a free 14-day free trial to Power Options, a 2-week trial to the Power Options tools. We're going to take a look at those at the end of the presentation a little bit. But we want to go down to the Trade Simulator tool. Now the Trade Simulator tool, this is not a projection of what your track record is going to be. In other words, I'm not going to show, what we're going to show here today, I should say, is not me telling you this is what's going to happen in your portfolio and you'll have success in this fashion. What this is a simulation of a trading record. In other words, let's think about if you entered into any strategy. You have a target goal for that strategy, whether it's a 30-day or 60-day time period. You have a target return. You have ahead of time what you've mapped out of what you're willing to lose on the position, and then you probably have an expected probability of loss. Now what we're starting off with here, we're assuming a target return of 10%, and we're going to assume a loss limit of 10%. So let's just assume we're buying stock. We're going to close out the position if we get to our 10% return. We're going to use a stop order and hopefully get filled at only a 10% loss if the stock moves against us. And we're going to flip a coin 100 times. Heads we win, tails we lose. All right? So heads the stock moves up, we make our 10%. Tails we lose, and the stock loses 10%. And we're going to estimate this with a starting capital of $10,000. Now down below, we're going to see our trading record. So in our first 100 coin flips, we only won 44% of the time. We lost 56% of the time. At one point of those 100 trades, we would have taken our account value from $10,000 up to roughly $15,627. So when we first started, we have strings of winners and losers. You can see that over on the right-hand side. So we had 4 winners in a row, then a loss, then a win, then a loss, then a few more wins. And around the 13th trade, we're close to that high point of 15,000. So we might think we have a really good trading strategy. But over time, the portfolio was down as low as $1,300, or $1,391, let's call it $1,400, and our ending amount is $1,800. So that's essentially an 82% loss over time. Now that's not going to be successful. Well, of course, it was a losing track record. We just need to win more often. Oh, there we go. Okay, this looks pretty good, doesn't it? Now we've won 56% of the time. We have more winners than losers. We took our account value at one point up to $22,409, and our ending amount after 100 random trades, we doubled our money. We're at $20,168. Okay, but at one point, we did suffer a drawdown. We were down to $6,792. Let's call it $6,800. So we were down 32% in our portfolio. Well, in a real trading world, if I'm trading a strategy and at one point I see that my portfolio is down by 32%, I'm probably making adjustments for deviating from that particular strategy, because we know, what we just talked about with Gambler's Ruin, if we're down 33% from where we started at any time, we know we need a 50% gain to get back to break even. Well, in this case it did work. We doubled our money, but in order for that to happen, we had to be right more often than wrong. Let's talk about covered calls for a minute, or naked puts even. I sell a covered call position 1 month out in time. Well, then I might be looking at a target return of 3%. And let's lower our loss limit. I'm going to try to lower the loss limit down to 7. Let's put it at 8%, following the IBD rules down to 8%. Now, to us, I can say that, well, the market's going to dictate when you're right or wrong. So I'm okay leaving this probability on a covered call portfolio, especially from what I saw in certain months of a 50-50 win-loss ratio. But some of you may be saying, okay, that's not fair. If I'm selling in-the-money calls, I have a higher probability of success. I'm probably closer to 60, 65, maybe 70% success rate. All right, so let's do that. Let's look at our target return at 3%. Let's keep our loss limit at 8% and change our probability of loss to only 30%. So we're assuming that 70% of the time we're going to be right, and 30% of the time we're going to be wrong. Ken asks, can you change the 100 trades to 5? No, I don't have we don't have an adjustment here on this simulator tool to change it to a lower number or a higher number of trades. So, but we're just thinking about this over time, okay? So here's a great track record. We're right 80% of the time, and we only lost 19% of the time. So we took our money, and right out of the bat, we did extraordinarily well. Okay, we won 5 times in a row and essentially got a 15% return. Okay, well, that's on the high side. That's being right 80% of the time. 70-30, our target goals, right? What happens at 70-30? Well, after our first few couple trades, we were able to take our high value up to 10,736, but over time, being right 70% of the time, our account value did drop to 5,900, and an ending amount would be at about 6,500. We're down 35% from where we started, even being right 70% of the time. We're looking to make a target return of 3%, a loss limit of only 8%, assuming we only get filled at an 8% loss, which we all know in some cases in a covered call trade, like might have happened with BBBY this morning, you might have an 8% stop loss, but you're going to get filled for less. But even being right more often than wrong, you're still going to lose money over time. Now, I had mentioned that the standard collars help solve some of my problems there. And let's drop this down, the probability of loss on this. I'm actually going to increase it. We're going to go up to 35%, to be right about 65% of the time, wrong 35% of the time. I'm going to keep my target gain at 3% with a standard collar, but I'm going to put my loss limit at 6% maximum. And you see here, this can work out over time, right? 73% of the time. Take our account value. At one point we did luck of the draw with wins right out of the bat, but we only took our account value down to 9,945. Still able to get 16,277. So, you know, a decent return on the position. Let's do that again. All right, right 69% of the times. 69% of the time, excuse me. 70-30 split here almost. Well, with the standard collar, making 3% when we're right, only losing 6% when we're wrong. We're having a small profit here. We have a gain, you know, 10, 12% gain. That's still pretty good, and we didn't lose that much. But the problem is we still have to be right more often than wrong. I still have to be right 65, 70% of the time in order to profit on that position. But let's talk about the married put. Now let's assume that with the married put, because we don't have our gains capped, let's assume that when we're right, that we're going to gain a good 6 or 7% on our position. You know, we might have a stock that moves up 10%. We might have a stock that moves up 15%. I've seen gains of 59.8%, which is a one-time thing, but we're going to take a look at that in a little bit as well. But on average, let's just say that we make 7% when we're right. It might take a 2 or 3 month period. It might be a longer time. But we're going to keep our risk down to about 5 or 6%. Let's call it 5.5%. Now let's run that simulation. Oops, and I got to change my probability. Let's assume that we're only right 50% of the time. All right, let's go ahead and run that. Well, naturally, when we're right more often than wrong, we're going to have extremely outpaced gains. I mean, we almost took our $10,000 up to $60,000. But look at this. Here's a track record where I'm actually wrong more often than right. We only won 48% of the time. We lost 52% of the time. We had a drawdown in our account of only about 15%. 14% or so, down to 85, 80, about 8,600. But over time, we still profit. We are actually wrong more often than right and still able to make money because we're controlling our risk, we're cutting our losers short, and we're allowing our winners to run. We're not capping the upside as we would with a covered call or with a standard collar position. This is the advantage of radioactive trading. And this trade simulator tool, you can go to this later on, radioactivetrading.com, click that resources tab, and you can put in your numbers for what you're expecting to make on a covered call position or a standard call or a naked put, what you're trying to limit your losses to, and then run those scenarios with your probability of loss and see how you'd come out over a track record of 100 trades. You can adjust the probability. You can even adjust the starting amount and factor in commissions also if you wanted to. You can put that in as well. And a lot of investors will say, well, I don't see how you're going to be able to make money when you're paying so much money for these in-the-money put options. Well, run your scenarios. Run your scenarios here and then let me know how it comes out. Send us an email to support@radioactivetrading.com when you play around with your numbers and let us know how it turned out for you. And then think about what you're doing in your portfolio. If that's what you're doing in your portfolio, how do you think it's going to perform over time? You will have months. You might have just started a new strategy 6 months ago that's working out really well for you, but the market's going to fluctuate. And the problem is that over time, consistently staying with one strategy that's not protected, as the married put is, but staying with a long-term strategy of covered calls or credit spreads or even buying calls and buying puts, it will come back to haunt you if you're not properly limiting your risk and I should say, applying proper money management. And let's get into that right now. When we talked about the radioactive trading techniques that were developed by Kurt Frankenberg, and we talked about what we're going to do. We're going to set up every position from the start. We're going to buy an in-the-money, far-out-in-time put option to limit our risk and leave our upside open. And then we're going to use 10 different income methods, 10 different adjustments to lower that initial at-risk, bulletproof the position, and earn extra profit. Concepts of radioactive trading, the first focus, of course, limiting risk. And then we want to leave the upside open, and we are avoiding the lie of leverage. This is a question I expected to come up when I showed that profit and loss chart of the protective put, and we will talk about this in just a moment, so you might have questions then. But a lot of investors see that and say, well, isn't that the same thing as a long call? Well, no, it's not. The long call takes advantage of doesn't say take advantage, but the long call puts you in a position of the lie of leverage. And everyone can say, oh, well, that's the same thing as a long call. It's a parity trade to long call, what you're doing. Not really, because if you fall into the trap of overtrading, if you don't apply proper money management, it is not a parity trade to the married put position that we enter at any time. You can risk too much of your position. Okay. And this is the initial structure. I've talked about this. We're going to purchase that far out put option 5 months out. We're going to keep it no more than 20% of the money. And this is a general setup, and we're going to get back to this. This was the old trade I promised in silver wheaton that we were going to look at, but we're going to go through the 3 core principles and then come back to this. On May 21st, 2010, I had silver wheaton trading at 17.20. We got filled at for about 300 shares at 17.20. And we bought a December 20 strike put for $4.30. So I'm adding almost a fourth or so of the capital into the position by buying this put. So now I've increased my cost basis to $21.50. But at any time, we're guaranteed to get $20 back. Anytime between May when we open the trade and December expiration, we're guaranteed to get $20 back. So the most we can lose on the position is $1.50 or 7% on the position. Norm asks, can you expand on that long call comparison at some point? Yes, I can. We're going to get there in just a minute. And then we had another quick question come in. I'm sorry, I didn't see the name here. I apologize. Hold on one moment, folks. Oh, Paul. Paul missed the beginning. Paul, yes, I am recording this presentation. I hope to have it in the archives by about 5 p.m. this afternoon, or maybe first thing tomorrow morning. All right, so this is the basic setup that we use when we open any married put position, any radioactive trade. I want to keep my risk in this position to less than 7.5%, 8% of my invested capital. We're cutting our losers short, but I don't have a short call or anything open on this position yet. So we're still leaving the upside open. Now the common detractions, of course, we are adding too much cost in the initial stock price. Well, we all know the cost of not having insurance. I have a feeling that many of you have experienced that as well. We're taking away from the potential gains by buying the put option. That the gains are limited due to the cost of the put. Well, yes, if the stock moves up, let's say 30% from where it is now, I'm not going to realize that 30% gain. But I don't know the future. I don't know the stock's going to do that. A stock that could move up 30% in 12, 15, or 30 days also has the potential to drop 30% in 12, 15, or 30 days. All right? And the idea is, do you want to maximize your capital by putting it into a risky position where you may end up not having a lot of your capital left if it goes against you, or do you want to protect the capital that you have to invest? Okay? And then, of course, a lot of investors say, well, you can't realize a profit until the stock is above $21.50. And that's not true. That's true if I hold the position all the way to December expiration. I make no adjustments, and the stock's trading below $21.50. Then I'll have a losing position. But that's not my plan. When I'm opening this married put position, I'm going to look to apply those 10 different income methods as the stock moves up, if the stock stagnates, or if the stock falls in price. I'm going to reduce that at risk. And if you've seen any type of profit and loss chart, whether we're even talking about a long call there that was mentioned by Norm, whether we're talking about a married put position, the advantage of buying this put so far out in time and in the money, the put's not decaying one-to-one with the stock. If the stock moves up 1 point, I'm not losing $1 on the put. Also, you see here, it's when opening this position on May 21st, the halfway point between now and December expiration is reflected by this curved red line. So halfway between now and expiration, I probably only need the stock to be trading at around $18 or $19 to break even. I don't need it to be at the $21.50, the total cost basis on the position. When I first opened this married put also, when I bought the stock, bought the put, I'm not $1.50 behind the 8-ball. I'm not down 7% when I open this position. The only thing I'm risking when I first open the position, or the only thing I'm essentially at a loss point at, is the difference between the bid-ask spread. I could liquidate the position right away, maybe sell to close that put option for about $4.20, just giving up 10 cents to the bid and ask, and that's all I'm going to lose on the position. This break-even line, this $21.50, that we need a profit, we need the stock to be trading above $21.60 in order to realize a profit, that's only true if we hold the position all the way to expiration and make no adjustments. But that's not the goal. Okay? Now, what does this initial setup consist of? What are we doing here that's different from others? Well, we're taking advantage of the 3 core principles of trading, the 3 core principles of radioactive trading, which in my mind is the 3 core principles of any trading. From the start, we're forcing an ideal size trade. By purchasing stock in the put option, we're forced not to overtrade or overinvest. We're avoiding the lie of leverage. Our risks are limited to single-digit amounts of the capital that we invested. We're taking advantage also of the at-the-money bell curve. And we're going to talk about that. We're going to go through these 3 core principles in more detail. But the at-the-money bell curve, both the initial setup of the married put and the income methods allow us to manipulate time value in our favor. And then, of course, the 3rd principle, the red line, or the time value decay, that's the proper approach for using time value in our favor. Why are we buying 5 to 6 months out in time? Because we're actually paying less per day for the insurance on the position. As we've talked about this, but too large a risk is devastating. We're forcing an ideal size trade to avoid the lie of leverage and apply proper money management. Okay? A risk too small is also an issue. 100% gain on a position, if you tell me that you just had a 100% gain on your last trade, and I'd say that's great. But if you only wagered a small amount, you're not really getting ahead. For example, if you told me that you bought an out-of-the-money call for 10 cents, and you sold it for 20 cents, and you only bought 4 contracts, well, you invested $40 and made $80. Well, you really made $40 total on the position. You bought it for $40, you sold it for $80, so you make $40. Well, that's good. You did have a 100% gain, but you're not really winning, especially if you had a loss of 20% or 30% before. The biggest reason for having just the right size, forcing an ideal size trade, is to impact the expectancy. Now, let's just say that we have a stock trading at $50 and we're shopping for insurance. We're looking at puts that are 5 months out in time. Oh, Frank asks a question I'm going to have to address a little bit later, okay? So, Frank, I'm going to get to your question a little bit later. But let's take a look at this. We're looking at the stock, and we talked about the out-of-the-money position. Well, if we have stock at 50, we buy an out-of-the-money 40-strike put, 5, 6 months out of time, it might only cost us $3. So we have an investment of $53, but the insurance doesn't kick in until $40. So we're risking $13, or about 25% on our position. If we suffer that loss, we need a 33% gain to get back to break even. Let's take a look at going slightly in the money. We buy the stock at 50, and we buy the $60 put for $12.75. Well, $10 of that we're guaranteed to get back because we have a put option that's $10 in the money from our purchase price. Our total investment is $62.75, so we're only risking 4.3, 4.4%. Now, if we go deeper in the money, can't we get lower risks if we go deeper in the money? Absolutely. Most of that put we're going to be paying for is intrinsic value. So if our stock's at 50, we look at the 75 put, price might be around $25.75. So our total investment is $75.75. That's a risk of less than 1%, but now the expectancy of profit is too small. Here's a historical married put view of Silver Wheaton on May 21st. And we saw that our 21-strike put here, or 20-strike put at the time, 1782, I'm sorry, $4.30. This is actually if the stock was at 1782 at close on May 21st. We got filled at 1720. But here you see the risks of kind of where we want to be, 6.5%, 8%, really maybe 5.2%. I can get a much lower risk by going deeper in the money. If we went to the 35-strike put, it's about 50% in, or almost 100%, I'm sorry, in the money. Well, our total cost would be $35.42. We're only risking 42 cents or 1.2% of the position. Is it better to have lower risk? Well, you're going to lose less money, but your expectancy of any profit is going to be much, much smaller. So it's kind of like the three bears, and this is discussed more further in the blueprint there. And what we're looking at with the three bears, of course, is that there is such a thing as taking on too little risk. We definitely know there's such a thing as taking too high of a risk. So this is forcing an ideal-sized trade. Now, this is an old slide, and Norm, I'm actually going to point you to a presentation I did recently. Actually, the presentation we did on Tuesday, a similar presentation was archived there, where we showed a different view of comparing the long call to the married put. I personally actually like the other example better, but we're going to go with this one. Many years ago, and I think this example might even be in the blueprint, let's say we have Walmart trading at $48. We buy shares of stock at $48, and we can buy the April 09 50 strike put for $3.50. All right, so we have $51.50 invested in the position, $48 plus the $3.50. We're guaranteed 50 back, so we're only risking, again, that $150 or 2.9% of what we invested in the position. Now, April 50 calls are trading at 150, so the argument here Norm's bringing up is, okay, well, it's the same position. If I just buy that long call for $1.50, I have the same risk as you. But see, now you have 32 times the buying power. You're risking 100% of that $1.50 into the position. Okay, let's say you have $5,200 to invest. Both you and I have $5,200. And in our example with the long call, you could buy 32 50 strike calls at $1.50 and have a highly leveraged position. If Walmart goes to 100, you're going to make a lot of money. All right, those calls are going to be worth $5,000 a piece. On the other hand, if over time the stock just stagnates or it drops down to $49 or $49.99, you lose everything on the position. The first thing to understand about leverage is we all know it can be used against you. This trade used the same capital and the same underlying stock as a married put, but the risk of loss is devastating. Now, I know the argument, and I'm going to do this. Let me pause the screen real quick here. I'm going to do something very quick. I want you guys to make sure you remind me to unpause the screen, and I am going to go here. This is just for Norman. I know I may be extending the webinar a little bit here, but I'm more comfortable and more familiar with this example here when I walk through it. Let's see here. Let's go to, sorry folks, 1 second. Okay, here we go. Is everyone able to see the screen now? This is from the presentation we did yesterday, and we're going to talk about the 5-line setup. This is a position from a year ago on June 20th, an RPM on PXP, Plains Exploration. On June 20th, we could buy the stock at $35.08, buy the January put at $7.25, so total invested is $42.33, guaranteed to get 40 back, so we're risking that range, that $2.33 or 5.5% on the position. Now, looking at the long call, a lot of investors say, well, the parity trade is you could just buy the January 40 call, the out of the money far out of time call, and at the time it costs $2.30. So the maximum profit is infinite, but the maximum risk is only $2.30. So we lowered our risk by 3 cents. This must be a superior trade. Well, let's take a look at that. Okay, there's the profit and loss chart of the RadioActive Profit Machine on PXP. Cost basis of $42.33, limited risk position of that $233, $2.33. Long call, break even essentially at $42.30, risking $2.30 on the position. Now, we talked about this, that the long call risks 100% in the investment, but you say the risk is only $2.30. So if I buy 100 shares of PXP, buy 140 strike put, have my risk at $2.30, but you buy one call, you're going to tell me that you're only risking $2.30. You're in a better position. Well, okay, but is that what you're going to do? Let's talk about the true nature of an investor. Now, here's the extreme example. You and I both have $100,000 accounts. I have $17,000 to invest in a position, and you have $17,000 to invest in the position. We have the married put here. We know the cost. We're guaranteed exit of 40, so we're risking 5.5%. With a cost of $42.33, I'm able to buy 400 shares of stock and 4 puts. That puts my capital invested at $16,932. Now my total risk, if I'm wrong on this position, the most I could lose is $932, but that's less than 1% of that total portfolio. Now, in your position, you have $17,000 of free capital to invest. Call cost is $2.30. it's 100%, you could potentially buy 73 contracts and invest $16,790 into long call positions. Now your total risk is at $16,790 or 16% of your portfolio. I know that's an exaggeration. I know that most of you are disciplined investors and you wouldn't put that many eggs in a basket. You wouldn't buy 73 contracts. But let's be honest about the nature of an investor, especially the nature of an investor using a leverage trade. If you are disciplined to only buy 4 contracts of that long call, what are you going to do with the rest of the capital? Are you going to put it on hold in your account? Or now are you going to take the remaining $16,000 that you have? If you only bought the 4 contracts, it'd be about $940, $920, excuse me, invested. Are you going to take the remaining $16,000 or so and now buy 4 calls on ABC? Maybe buy 5 calls on XYZ, maybe trade a couple spread trades with that remaining capital. See, now we are no longer close to parity anymore. The only true parity to the married put, if you're comparing it to a long call, is that if you're disciplined enough, if you know that you could only afford to buy 400 shares, if you look at that long call, you have to discipline yourself to only buy the same number of contracts that you could afford to buy, so you keep that risk to less than 1% of your total portfolio, and you take that remaining $16,000 and leave it on hold in your account and don't put it into another trade. That is the only true parity trade. And Kurt does discuss this in the blueprint, but the minute you start using more of that capital, the minute you start using more of this to buy more calls on other stocks or to trade other spread trades, we are no longer at parity. Because you're risking more of your portfolio in different positions, I'm still guaranteed to, worst case scenario, only lose 5.5% of what I invested in this, and I'm keeping that at 1% total of my portfolio. Okay, so I just wanted to show that very quickly, and now I want to navigate back to where we were. Hopefully this is the right one. Yes, there we go. So that's Norm. I just wanted to give you a little bit more insight as to what we talked about on Tuesday as well. All right, let's go ahead and I think we just covered this. Why force an ideal size trade? That other presentation we just linked over to sort of reinforced that. Okay. Now the ATM bell curve, I'm going to go through this because I made some promises to look at 2 other positions with the eye to the CEGA model here. So we're going to go through this. The second principle is the ATM bell curve. This is showing us how to make money after we get into the position. It shows the first standard for buying time cheaply and selling time at a quality premium. And we just know this. Sorry, you've probably seen this before. This is the at-the-money bell curve. This is looking at a call where we're just reflecting the time value of the options. The at-the-money options will always have the highest time value on any chain, regardless of the stock, regardless of the month expiration. If you're comparing the same month, different strikes, the at-the-money is always going to have the highest time value. You lose time value as you go to the higher strikes to out of the money on the calls and in the money. Now, the in the money is more expensive because you're paying intrinsic, but you have lower time value. So when we want to buy, we're going to buy in the money or out of the money, so we're not paying into a lot of time premium. Of course, when we're selling, we want to sell at the money to maximize the premium we're taking in. And here's just a quick view of that, historical view of Apple when it was trading at $354 on March 14th, 2011. The 1 month out chain, you see the at the money 355 strikes. We have a time value of 1090 monetarily, or 3.1%. And as we go deeper in the money on the calls, the time value decreases. And as we go further out of the money, the time value decreases as well. Same on the put side. Our at-the-money 355 put has a time value of 1061. We decrease percentage time value as we go deeper out of the money in the put in this case, or deeper in the money for the put options as well. So we want to buy time cheaply and sell time. And of course, I'm sorry, this also works further out. If we go further out in time to October, which was about 7 months out at that time, well, the at-the-money 355 call, we have about 10%, 10.2% time value. That lowers as we go deeper in the money and deeper out of the money, whether we're looking at calls or puts. We want to be selling in this range. We want to be buying in the lower ranges as well. And so that helps us to maximize the time value. We apply this when we're opening the married put position and when we're applying the income methods. And of course, our third principle, real quick, is the decay line. Why are we buying a 5-month out put option or 6-month out put, a minimum 5-month out put option on these positions instead of near term? And the reason why we're doing that is because we want the time value decay to work in our favor. There is one guarantee in options trading, of course, and the guarantee is that as we approach expiration, all options will go to zero. I see a question from Marvin and Frank. I'm sorry I went a little bit long in the tooth here. I still want to get to that silver wheat and trade a little bit, and I also want to maybe take a look at a live trade using the power options tools. I am going to get to your question soon. CW did comment in and asked, how does that relate to Delta? CW, can you send me another quick message as to what property you're referring to regarding the Delta? Do you mean the ATM bell curve, or do you mean the general setup itself? Okay. Here is just a standard time decay curve of an option. And what we see here is common. Yes, it does assume a couple of things. It assumes volatility stays the same. It assumes the stock price stays the same. We know that's not the case, but at the same time, if we're just comparing apples to apples, this is the curve we would expect. Any option will have this type of curve. When you get into the last 30 days to expiration, your time value of your option is going to decay rapidly. When we start going 4 months, 5 months, 6 months out in time, that decay is much, much slower. So if I open a put option that's 6 months out in time, even though the stock's fluctuating on me, that time value I paid into is not decaying very quickly. And we start to get closer to 60 days to expiration, 90 days to expiration, and then 40 days to expiration is really when we see that time decay. So to have it work in our favor, we want to be buying farther term. And Norm, if you're a long call investor, you've traded long calls before, you probably weren't buying near term, or definitely probably weren't buying weekly calls. You're buying options that are 4, 5, 6 months out in time. A, to give you more time for the stock to move in your desired direction, and B, because you don't want to suffer the time decay. In the first 2 or 3 months, you want to be able to manipulate that in your favor. We want to be selling premium here. In the last 30 and the last 45 days, we want to be buying protection further out in time. Okay? Now, we don't know the future, but we do want to manipulate time value. As options traders, that is our true profit. The time value we keep and the time value we stop ourselves from losing, and that's why we want to buy further out in time. We want to sell near term. It limits our annualized cost when buying. It increases our annualized return when selling premium. All right, so the core principles, forcing an ideal size trade, at the money bell curve, and of course the radioactive decay line. These 3 core principles really apply to any investment strategy, but we're showcasing with you today how we use this in radioactive trading and why it is important to us. Okay? All right, so what are we doing now? Now that we've talked about the setup of the RPM, how it relates to other strategies, and how it has benefited my portfolio compared to those other strategies that I attempted to trade over extended periods of time, the covered calls, the calendar spreads, even the standard collars, which I still trade. Well, what we're going to do is we're going to set up that initial position with a limited risk in place, forcing ourselves to cut our losers short, allow our winners to run. And the stock's going to fluctuate after that, and we have a goal in mind when we open the position, but we're going to use those 10 different income methods discussed in the blueprint, whether the stock moves up, whether it falls, or it remains neutral, to lower that at-risk amount and potentially bulletproof the position. And bulletproof means that when we've lowered the total cost into the married put position below the guaranteed exit of the put option, now we can make money if the stock falls, and we can win if the stock goes up. So heads you win, tails you don't lose. Okay. John asks, at some point you're going to talk about using deep in the money calls instead of stock. Do you mean just buying deep in the money calls straight out, or using the in the money long strangle? In other words, buying an in the money call and buying the put I would have bought in the married put position. Actually, we're not going to talk about that today, but if you let me know kind of what more you're referring to, John, I can point you to either the archive from yesterday's webinar where we did discuss that, or Tuesday's webinar, my apologies, or other archived articles that Kurt has where it discusses the comparisons as well. But we're not doing that in today's presentation. We were addressing the parity trade of what most investors will look at, say, oh, well, your married put is just the same thing as an out-of-the-money long call. You're taking the same risk. And I think we've shown how that's not really true unless you apply the proper principles. Okay, here's that silver wheaten setup again from May 21st, 2010. Right, we have our risk of $1.50 or 7% on the position. We bought a put option for $4.30, which adds into the position. All right. Okay, so why this trade on SLW? Well, the CEGA model, that we discuss in the blueprint for each of the 10 different income methods also applies when you're opening a position. So when I was looking at this position on 5/21, my conditions were that the current conditions were the stock had recently pulled back from a certain price range, but it was still in an overall uptrend. My expectations when I'm opening a new married put positions, I'm looking for stocks that I feel have a good potential to move up maybe 5 to 8% in the next 30 to 60 days. And in this case, I was thinking the stock may rise as high as $20 in the next 60 days, but I do want to keep my risk less than 7% and have a long-term insurance policy. Now my goals. When I opened the married put, silver wheaton's a little bit volatile, so my goals were to generate income if the stock rises using the maybe income method number 6, number 5, potentially number 1, or if I saw an opportunity if the stock moved up in those first 30 days to bulletproof the position using a different income method number 4, then I would look to do that as well. Now, if I have my goals going into the position, what are my goals for an RPM? I have my personal goals of what I'm looking for to average every 30 to 60 days. I don't feel forced to try to make 2, 2.5%, 3% every 30 to 60 days, but my goal is on a winning RPM is that I want to make sure that I'm averaging that goal. So if I close it, 90 days from now, 3 months out in time, I want to make sure that I maybe have at least a 7 or 7.5% on the position. So those are my goals. This is the CEGA model here. What are the current conditions? What were my expectations? What are my goals? And then, of course, that dictates the action. We're going to purchase the stock in the put option, which fulfills this long-term insurance policy at or less than 7% at risk, and have the unlimited upside with keeping an eye to the income methods. Okay, now, the stock was purchased at this point. And this is where we were filled on the 21st of May. After that, the stock did move up as we expected. You see here around June 20, June 21st, it hits a peak, but then it fell back down, and then it hit another peak on around June 28th. And then it pulled back after that slightly to August expiration. Now, so what we did on the trade is on 6/28, and we had that little pop up above 21, and then it pulled back, and then it had the second pop. So when SLW opened at 21.45, now I could have chose to liquidate this position at the time with a very good profit, but I still had further expectations for the stock, and I wanted to try to bulletproof the position because I still have another 5.5, 6 months in the trade. Remember, I'm holding a December put. We had the initial at risk at $1.50. So we put in an order to sell the open the August call, a little bit more than 30 days out in time, but I'm not going beyond 60 or 70 days out. And the reason why I was looking at the August 21 call is because it was priced right around $1.50. So I did put in an order to get filled at $1.50. It didn't trigger. I lowered it a little bit. We got filled at $1.48. So the new at risk, if the call expires, would be only 2 cents per share. Essentially, this position is bulletproof because that put's not going to go to zero anytime soon, especially not by August expiration. Sorry, the formatting here fell a little bit, but you can see where we're going. The new position, the new profit and loss chart, have our call sold at $1.48, so that lowers our total investment in the position to $2,002 per 100 shares. We still have that 20 put, so we're only risking $2 or 0.1% on the downside. Now this did cap my gain. Income method number 1 does cap the gain, which is why I don't use this income method that often. Ernie uses it very well. He uses income method number 1 very often. Fusion subscribers can track Kurt's trades and also the Ernie at Power Up portfolio. And Ernie's really adept at rolling and maneuvering income method number 1s. I'm not. I tend to let it get away from me. So I did cap my gain, but applying my CEGA model I was comfortable with this potential that it might be 11.6%. Probably wasn't going to realize the stock could be trading right at $21 on August expiration in order for that to happen. But let's say if it moved up to about 22, 22.50, I'm still comfortable with this profit line here, and I have managed to essentially cancel all of the risk on the downside, a bulletproofing move with income method number 1. So the conditions, this best matched my CEGA model on June 28th. I looked at the other income methods. I tried to bulletproof with income method number 4 at that time, but it wasn't available to do. And I wasn't quite clean on income method number 6. So the conditions, the stock has moved up as expected, actually exceeded expectations. We could liquidate and realize our goals that we set in the beginning, but the stock has exceeded initial expectations, and looking at the movement, we felt that the stock was going to stagnate but still had upside potential. We didn't see this large gap continuing at the time, but we still think it had upside potential for the next few months. Now the initial goals have been met. However, with the new expectations in mind of the stock stagnating over the next 40 days, 50 days or so, we want to look for an adjustment that will cancel most of the risk, almost bulletproof it, and generate income. So income method number one satisfied the new expectations and the goals for that RPM. We tried to look at a 4 and it wasn't available. We tried to look at a 6 and it wasn't there as well. So we sold the action now. We sold to open the 21 call. Now after we sold it, we're going to look to close or adjust the call if the stock moved above $22, moved about $1 or so above our obligated price. Or if the stock pulled back quickly and we had an opportunity to buy to close that call for 80% of the premium we sold, we'd look to buy it back at that time. Now, as I mentioned, the best case scenario is with the stock be trading right around $21 at expiration, at August expiration. One of the reasons why this trade was so good is because that's exactly what happened with the first income method. The stock was trading right around $21 per share, fluctuating right around $21 per share, and a little bit below at August expiration. We had generated a $1.48 premium. We were able to buy to close the call for 3 cents. I didn't want to take the chance of it being in the money, but around 1 o'clock, 1:15 on August 21st, we were able to buy to close that call for about 3 cents. So we kept a $1.45 premium, so we still have 5 cents at risk on the position, or about 0.3%. After that one income method on the position, we were essentially bulletproof. Now, why am I saying bulletproof even though I still have $5 of risk? That's $5 per 100 shares, so it's really 5 cents. Well, why I'm saying that is, remember that that's risking $5 all the way at December expiration at this time. So if I held the position all the way to December expiration and made no other adjustments, and the stock was trading below 20, which it wasn't at this time, it was trading around 21, then we'd lose that $5. So that put's not going to go to zero until we get to August expiration. Okay, so this position is essentially bulletproof. Now, we just shared with you for free income method number one, essentially, selling a call. It's talked about in the sketch. It's given away for free in that free white paper, the sketch at RadioActiveTrading.com. But I can't tell you how many times in the last 4.5 years where I've had investors who joined us for one of these webinars, saw the initial setup, and then went ahead and sold a call against it the wrong way, called me up 3 weeks later and said, I'm in trouble. I don't understand how I'm actually losing more than the initial married put setup after I sold the call. Well, there's mistakes that are made. The first mistake is you can't sell the call too soon. You want to wait for the stock to move up in price. 5% is usually a good rule. But if the stock, when you open that stock, let's say I bought Silver Wheaton again at $17.20, and we had bought the 20 strike put, so we had $21.50 invested again. If I tried to sell the 18 call right away, when I first opened it on May 21st, if I sold the June 18 call, let's say even it collected $1, well, I canceled my downside risk, right? I generated premium, so we lowered the risk on the downside. But now if the stock gapped up or moved up quickly, as it did, to $21, remember, we had $21.50 invested. Let's say we collected $1 for that 18 call, so our total investment in the position is $20.50. If the stock moved up quickly as it did to $21.45, the problem here is that I obligated myself to deliver shares of stock at 18, and my put is losing value as the stock moved up. I'm not gaining any more positive delta because I capped my gain at 18, so my true risk is actually now $3.45, not on the downside, but on the upside in the direction I thought the stock was going to move. So you don't want to sell the call too soon, and you never want to sell the call below the put strike price because your cost basis is going to be higher. You don't want to cap the upside. Why would I want to cap the upside? Remember, when I was looking at this position, I identified a position that had the risk I want, but on a stock that I expected or have the expectation is going to move up 5 to 8% in the next 30 to 60 days. Why do I want to cap my gain right away just to generate a mere 1, 1.5, maybe 2% on the position? That's going against my expectation. I'm putting myself in the hole. So you want to allow the stock to move. Hey, and if the stock stagnates or falls from when you first open the position, there are other adjustments that will work better. The other 9 income methods that are available in the blueprint, those will be able to work better than income method number 1, depending on the scenario. You don't want to cap your upside, especially if you cap your upside and result in a higher loss if the stock does go in your desired direction. And we definitely don't want to sell a call with too little premium. In other words, when I entered that married put trade bought the stock at 17.20, bought the 20 strike put. If I adhere to the rule of not selling a call below the put strike price, but I went ahead and sold the June 20 call, well, I might only receive 40 cents or 50 cents. Is that really helping my position? And of course, taking advantage of the three core principles, looking at the APM bell curve, the best opportunities to apply an income method, and by that I mean the bullish ones, income method number 1, number 3, number 4, number 5, and number 6. The best time to do that is when the stock's trading right at the put strike price, because the put's time value is increasing actually as the put goes from in the money to at the money. It's an interesting phenomenon that you can see in some of those archived webinars there we're not going to show today. Okay, so the summary of the technique, we're going to use the married put setup. That's the starting point. We showed why we're using it earlier, because we want to cut our losers short and allow our winners to run. We're following the three core principles of radioactive trading. We're forcing an ideal size trade, we're taking advantage of the at-the-money bell curve, and we're putting the time value decay line, the red line, in our favor. And then we use the 10 different income methods to lower the initial at-risk amount. Now before I jump into PO, because we're about an hour and 10 into the position, I want to be respectful of everyone's time. What I'm going to do right now is I'm going to do the brief promo. Okay, I'm going to talk about the blueprint. I'm going to go to RadioActiveTrading.com real quick to show you where you can see some of those archived webinars I mentioned, and some of the other articles. I'm going to do this now, but then for those of you that are able to stay for the next 5-10 minutes or so, we're going to go back to power options, and we're going to look at one of the one of the married put positions, the RadioActive Profit Machines in our webinar portfolio and power options, and kind of run through very quickly applying the CEGA model, looking at what income methods might be available. Okay, well, the blueprint is the only place where you get the full in-depth discussion of the three core principles of radioactive trading, how to set up the position, and the 10 different income methods. The price of the blueprint is $339, and then, of course, for about $11 for shipping inside the U.S., but we also include several bonuses with this. Kurt and I did a 2-hour presentation, part of the Mastery Series CDs, and the first one was the Foundations of Radioactive Trading. It's it's about a 2-hour and 20-minute long video CD that goes more in depth in those three core principles we just discussed. And if you purchase the blueprint, you get that first CD, that Mastery Series CD, for free. Blueprint owners also receive a free 30-day trial to Power Options. We're going to show that in just a minute. So you use the Power Options tools for free 30 days. And if you're already a member of Power Options, or if you're on a trial, that 30 days will just be added to your existing account. Kurt, so the service on RadioActiveTrading.com, where you can follow Kurt and Ernie's trades, as I mentioned. There's also a search tool that you can use to identify new RPMs, a stock insurance tool where you can put in your stock and your stock symbol and your cost per share to evaluate the insurance, what puts are available there, and also several timed lessons that Kurt has put together for you to help absorb the materials in the blueprint. But you get if you purchase the blueprint, you can get your first month of Fusion for only $10. It's a $59 discount. Kurt also put something together called the Quick Action Guide. It's about a 12 or 15-page document that shows you how you can get started quickly with the radioactive trading techniques and the blueprint. And of course, the blueprint also comes with a money-back guarantee. If you're not satisfied with the content in the blueprint within the first 30 days, just send it back to us and we'll refund your money. Okay, so let's go over to the products page here with RadioActiveTrading.com. I'm going to click on the products page. On the products page, you can view the table of contents for the blueprint as well. And there's also a link here where you can listen to the first chapter, sort of Kurt's history, before you buy the blueprint. I'm sorry, before you buy the materials, you can listen to the first chapter and read through the table of contents. And it's not shown here, but if you pick up the blueprint, we'll make sure you get those bonuses I just discussed. Now, in addition to that Foundations of Radioactive Trading 2-hour and 20-minute long presentation, there are 5 other Mastery Series CDs that Kurt has put together for you. And the 5 CDs are, you have the Income Methods Beginnings, Income Method number 1 and 2, Profits with Puts, Income Methods 3 and 4, the Money Nets, Income Methods number 5 and 6, Combining Income Methods, and of course the Advanced Income Methods as well, Income Methods number 7, 8, and 9. And that's all discussed right here. You can see that on the bullet points. We do have a kit available where if you purchase the Home Study Kit for $5.99, you get the blueprint, of course, all the bonuses I mentioned, the 6 Mastery Series CDs, and you also get a 30-minute consultation with either Kurt or myself with the purchase of the home study kit. And this price here, the $5.99, it also includes the money-back guarantee, but it is a 35% discount from what it would cost you if you purchased the blueprint by itself and the Mastery Series 6 CDs by themselves as well. That would cost you $923 if you did them individually, so you're getting a 35% discount if you pick up the home study kit. And of course, the information here, also, if you purchase the blueprint, you're not done. You can still join us for any of the webinars, but you can send us an email at any time to support@radioactivetrading.com or call us here at the office. Myself or Ernie will be more than happy to help you out. So you also get free support. I can't tell you what to do with your trades. I can't give you advice on a specific trade, but we can walk through the numbers as we're going to do in just a minute here on Power Options for that webinar trade, that paper trade in the webinar account. John, you bought the blueprint about 5 months ago, and you finally read it twice, and you're enjoying it. That's fantastic, and you need to set up that lesson with Fusion. Yeah, just send us an email, John. We'll get that set up. And, John, in addition to your comment, I want to go to here to free webinars and podcasts. Yesterday's presentation, John, the one that's archived here, the 3 core principles and trade comparison, that slide presentation that I showed with the comparison of the married put versus the out-of-the-money long call, that was one of 3 trade comparisons we made yesterday. The first one was getting into the stock with a naked put first and trying to do a calendar put spread to get in the stock at a lower price and why it's better not to do that as opposed to just buying the stock and buying the put, and using the in-the-money long call, creating that in-the-money long strangle as opposed to the married put. That was the second comparison. So when you have the time, John, check out the 3 core principles in trade comparison, and you can fast forward a little bit in so you get to the trade comparisons so you can see my thoughts on the in-the-money long strangle versus the married put position. Frank, your earlier comment, can you get a better spread price by trading the put separately from the underlying stock? Yes, if you time it right. If you time it wrong, you would have been better off just opening the married put to begin with. I tried all of that. The 3 comparisons I did yesterday are not just because they're questions that come up from investors and they're the right questions to be asking, but those are the exact processes I went through when I first started trading radioactively. Oh, well, I've been trading for 8 years. Kurt's buying stock and he's buying a put. Well, I can do better if I sell a put first and buy the put so I can get in at a discounted price. Oh, won't I do better if I buy an in-the-money long call instead of stock and still buy the put? Won't that work out better? And oh, isn't the out-of-the-money long call the same? Oh, and aren't I going to do better if I time the trade? If I buy the stock and when I think it's in an uptrend and then I wait for it once it moves up to get the put at a cheaper price. I tried all those scenarios, and I found out the hard way, even not listening to Kurt, not taking his advice, heeding his advice. I learned the hard way myself from that it's always better to just buy the stock and put at the same time. When I've got in a position, a stock that I feel matches my matches my expectations going forward, matches the current conditions, why do I want to try to get an extra 20, 30, 50, maybe even 60 cents out of that position? Because if I'm wrong, if I buy the stock and wait for an update to buy the put and the stock falls, now I'm in trouble. I've already locked in that loss essentially on the stock position. So if you can time it right, great, Frank, but my experience was I was never able to time it right to do that, and it took too much effort. I am much more comfortable just buying the stock and the put at the same time. Okay. Oh, I'm sorry. The other question Marvin asked earlier, he's a radioactive trader. He owns the blueprint. He had a married put on his position, and he had sold out the stock and is just holding the put, waiting for it to pull back, waiting for the stock to drop to repurchase at a lower price. Have you done this since you agree with it? That still comes down to the same principle. I've seen Ernie do this, Marvin. I don't typically tend to do it in my account, and the trick with that is that it all comes down to timing. If you're right, that can work out for you. But if you're wrong, and now the stock starts to shoot up, you've got to buy it at a higher price, and the put that you own is declining in value. And remember, Kurt has 2 popular sayings that he usually does a better job of when he's presenting these presentations. We already talked about the one, cut your losers short, let your winners run. The other one is, don't time your trades, trade time. Take advantage of the ATM bell curve and the radioactive decay line in your favor when you're opening the position and when, of course, you're using the different income methods. When you try to time your trades, that's usually where you end up getting hurt. Okay? All right, so we talked about the blueprint there. Showed you where you can get more information on it. You can see the table of contents, of course, and listen to the first chapter and that's in the Products tab. And then for the free webinars and podcasts, you can watch Tuesday's presentation right there, 3 core principles and the trade comparison. Some of it we reviewed today. Actually, it was a different view. Now, for those of you that are willing to stay for a couple more minutes, we're going to navigate back over to Power Options. By actually navigate, I'm not going to navigate, I'm just going to go there. We're going to go into the My Portfolio tool and the Profit and Loss Portfolio. And this is our webinar account. These are mostly paper trades, although I am in 2 of these married put trades right now. Very similar setup, the Goldfields and the Humana Gold position. I'm actually in both of those in my personal account right now, and I do have a collar on Plains Exploration, but it's not this married put position. Okay, so what we're sharing with you today, I'm going to show you something here, a position that was opened on April 2nd. This is actually an RPM I'm in, but I've made other income methods that we're not going to show today in my personal account, but we're just going to take a look at this paper trade. So let me pull up the profit and loss chart here to give you a better view of this RPM. We're simulating that on April 2nd, 2012, we purchased 100 shares of SH. This is the ProShares Short S&P 500 ETF. This is one of the ways that you, if you feel that we're in a bearish market, that you can still use the married put techniques in a bearish market. I bought a short ETF, an ETF that counters the S&P, well, it moves counter to the S&P 500, so this SH is going to move up in price as the market falls. But I set it up as a standard RPM and bought stock at about 35.15, and on the same day we bought the November 37 put. It had about 220 days to expiration for $3.10. Total invested was $38.25, guaranteed exit of $3,700, so the maximum risk is 3.3%, and the maximum profit, of course, is infinite. This is the initial setup, and I'm doing it on an inverse ETF. By the way, I don't trade the 2 times inverse or the 3 times inverse ETFs, just to let you know, but I will occasionally trade an inverse ETF here to play the married put position in a bearish market. Okay, so that's the initial setup. It was April 2nd, 3.3% at risk, low ETF, so even though it is an inverse ETF, still low volatility, low at risk amount, and I'm not that deep in the money on the position. Okay, so let's go back to the profit and loss portfolio. Now that the stock has moved up, remember what I said is that when I look at a position, I'm looking for a stock, and we'll see here the first line is the stock price and the second line is the put price, change in the put monetarily or percentage. So when I first come into my portfolio, I'm looking at this column here to see what is the gain and loss in some of these stock positions. And here, remember what I said, that I'm looking for a stock when I first open an RPM that I feel has the potential to move up between 5 to 8% in the first 30 to 60 days. Well, there we are. It's moved up 5.8%. It's currently trading at 37.18. And that's right at my put strike price, isn't it? The put's now at the money. So we want to evaluate some income methods, and how we can do that on Power Options. I'm going to go to the Position Actions menu from the portfolio, and I'm going to go to Position Analysis. This is going to give us a breakdown of our current position on SH. We saw that we had the initial at risk. Now we only have 149 days left to November expiration. When this was open in April, it was about 220 days. Excuse me. So we see our current liquidation value. This is helping me with my CEGA model. We have my original position value. I see my current liquidation value, 1.6 after 80 days. So I may not want to liquidate right now because I'm not at my goals. And of course the future expiration, this is not projecting where the stock's going to be. It's simply saying that if the stock stays at 37.18 for the next 149 days, we'd have a loss of 2.8% on the position. The stock has moved up, so we wouldn't suffer the full 3.3% loss, but we'd still have a loss on the position. Okay, but as I scroll down now, we see some potential income methods. And here's our opportunities first for income method number 1. So the stock has moved up. We could consider selling an August 38 call for 75 cents. This might cap our gain at 4.1%, but we're going to lower our risk to 1.3%. Oh, of course, we could do the July 38 call as well. It only generates 40 cents of net credit, so we'll lower it to 2.2%, and the 39 call is around 50 cents or 2% of net credit. Okay, so it's great to see that numerically, but when I really want to apply my CEGA model, well, I know what the conditions are. The stock has moved up, it's trading slightly above my put strike price as I expected. My goals, well, I'm not going to liquidate now because the liquidation profit is not matching my goals for this position, but I still may want to generate income or get it closer to bulletproof status But now I have to ask myself, what are my expectations? And to evaluate the expectations from that rollout opportunity, I'm going to link to Simulate Trade. Now I have a side-by-side comparison. Here's the married put as it stands right now, current return of 1.7%, maximum loss of 3.3%. If I make this adjustment on the position, we sell the 38 call for August. Well, we cap out at a max return of 4.1% if SH is trading right at 38 at August expiration, but we did manage to lower our risk down to 1.4%, and at August expiration we still have 3 months of insurance in place. But tracking this position, if my expectations are that I think SH might move up to $39 or to $40 per share in the next 30 days, I'm not sure if I want to use this income method. There might be a different income method that I want to use. Or if I'm more concerned that the market might turn and actually increase, so SH would have a pullback and move down in price, well, sure, I generated lowered the initial at risk to 1.4%, but if I want to be more protected, I might want to evaluate a different income method. Okay? For example, oops, sorry, folks. Oh, that's not where I want it to be. I'm sorry. Here we go. Let's go here. Let's get this right. For example, one of the adjustments that we see here, another adjustment, income method number 3, what Kurt calls the bulletproof vest. If I'm concerned about a pullback and I'm thinking about exiting the position, I can sell to close my November put and buy to open a July near-term put at a higher strike. And you see here that it's bulletproof. I have a negative at risk, which means I'm guaranteed at least a 0.4% return, but I'm not risking anything more if the stock has a drastic decline in price. See, that's part of my CEGA model. When I evaluate the expectations, that's going to guide me to which income method I'm going to use. But of course, as I mentioned, we're helping you with the mathematics here on power options. We're doing some of the calculations for you to give you a good idea of what you could do, and that Simulate Trade tool is very helpful in evaluating your CEGA model, but the only place, of course, to find the CEGA model for each of the 10 different income methods and when you would use one over the other is, of course, right there in the blueprint. All right. Well, I went much longer than I wanted to, but that's okay. I think we got some useful information. Ladies and gentlemen, I want to thank you for joining me today and staying with me till about 1:30. If you have any other questions at any time, remember you can send us an email. But let me navigate back over there real quick. I apologize, folks. Is this the one I want? Yeah. There we go. I'm sorry, folks. If you have any questions at any time, just send us an email to support@radioactivetrading.com. Remember, in the Resources tab on RadioActive Trading, you can start that 2-week free trial if you haven't yet. You can go to the Resources tab and click the 2-week trial, the Resources tab on RadioActive Trading, or just go to powerop.com/RAT, and you can sign up for that 14-day free trial. And remember, if you have also questions anytime, you can email me to support@powerop.com as well if you have questions about the Power Options tools. Did archive this presentation. I hope to have it up by about 5 o'clock this afternoon. And, of course, remember, you can call us toll-free during market hours at 877-992-7971. I'm going to let you know that I'm not going to be available for the next 20 minutes or so. I'm going to take a break after the webinar. But feel free to call us during market hours anytime at 877-992-7971 or just send us an email to support@radioactivetrading.com or support@powerop.com if you have any questions. Thank you, ladies and gentlemen, for joining us. I hope you got a lot of useful information. This webinar, again, will be posted in the archives hopefully by around 5 p.m. this afternoon. And everyone take care. Happy trading. Have a great weekend going forward if I don't see you tomorrow sometime or talk to you before the weekend. We'll see you soon. Good night.